All right, man. Thanks for stopping by. Take care. All right. Hey there, folks. Welcome to today's The Steady Trader video. A lot of people have this thing called analysis paralysis. I don't know if you've ever heard of that or you know what that is, but essentially what they do is they take a piece of news or whatever pertaining to a stock or an index, and they're really trying to take it apart. Now, if you remember yesterday's video, we talked about how we know a lot less than we think we do. Remember that book that I suggested you read, Thinking Fast or Slow? Fast and Slow, I think it's called. But keeping that in mind, a lot of people still try to go very, very deep on things when really a lot of times it doesn't matter as a trader, right? The reality is, as retail traders, for the most of you, you don't have access to a crazy amount of detailed information about any single company. You don't have access to visit these companies like analysts do, several times a year. You don't get to talk to the management, all that stuff that these analysts get to do. You don't get to do that. So I'm going to give you a trick right now that I think is going to help a lot of you dramatically when it comes to stopping your losses as well as taking profits. So for example, today is June 1st, 2018. A little thing called the U.S. jobs report that's coming out as I'm recording this here. It's coming out in about an hour or two, I think. Maybe by the time you watch this, it has most likely already come out. And so what's important to understand is that the news itself, the reaction to the news is much more important than the news itself. Let's turn this around. So the reaction to the news is more important than the news itself. So, for example, let's assume the jobs report is amazing this morning. Okay, I have no idea what's going to happen, but let's assume it's very good, and the stock market drops. Right? As a trader, you have to respect that reaction. So let me show you guys this on the charts. So what I prepared here is a chart of, in this case, it happens to be shares of JP Morgan. Okay, and what I'll show you here is the reason I chose this chart is it's got a very clearly defined chart and a lot of support. So I'm going to zoom in a little bit. What you see here, this red line here is our 200-day moving average. Now, if we zoom in a little bit closer on this, you can see that right now there's a lot of technical support through the lens of horizontal support, right? You can see that there was support here, here, roughly here, here, and right here, right now. Now, the difference between all these other support areas and right now is that right now the support area is coinciding with the 200-day moving average as well. So we have what's called a confluence support area right now. Now, let's assume the jobs report, like I said before, just this is a scenario, I have no idea, right? Let's assume, again, great jobs report, but the market, including shares of JP Morgan in this example, drop below this technical level. As a trader, you have to respect this. If you're a long-term investor, if you're a mutual fund or some sort of corporate investor, and you have a long-term holding in this stock and blah, blah, blah for 15, 20 years for your pension fund that you're managing, that's a different story. But as a retail trader, even despite the fact that the jobs report may be great, if this technical support area breaks, and let's say you're long the stock, you got to respect it. You can always get back in, right? And I think we've talked about this several times here in these videos on the YouTube channel, and God knows I talk about it to our Trade Alert Service members and Clubhouse members and coaching clients, I don't know, almost every day probably. It's important to understand that you can always get back in, right? So if you get stopped out of a trade, whether that's long or short or sideways or whatever your strategy is, you can always get back in, right? We always want to think in terms of risk and not in terms of reward. And that's what I'm showing you here. That's just another example of that. So the quick takeaway here is that the reaction to the news is more important than the news itself, right? The reaction to the news is more important than the news itself. Very, very important. That was another one of those milestones that I I don't think I really honestly truly sort of valued that lesson, which was taught to me by a mentor as well, until maybe 10 years ago. It wasn't that long ago but when I did finally get to understand that, I took it to heart, and it's really changed the way that I trade and the profitability thereof. So I hope this makes sense, folks. Have a wonderful weekend, and I'll see you guys probably on Monday. Take care.